Hey there, Lyndon Holdeman, Holdeman Realty Group. For 20 plus years, I've been helping buyers and sellers and investors buy and sell real estate in the Las Vegas Valley. And today I want to continue our three-part series on credit. And so this is a fairly short video. We're just going to talk real quick about a couple key points, actually 3 points that are kind of boiled down into 2 about things that you should be aware of if you're thinking of purchasing a property or purchasing a home, on things that can affect your eligibility, your qualification, and or hurt or help your credit score. And so the first thing I want to chat real quick is debt to income ratio, which ties into the second part of that with your credit card or credit line utilization. So I think most people understand this, but not all. But if you have credit lines, let's say you have between all your credit cards and lines of credit, or whether it's a PayPal line of credit, or all these different things that may be an unsecured line of credit that shows up on your credit report. If you have, let's just use 100,000. Some people have way less than that. Some people have way more than that. But if you had $100,000 worth available credit and you've used consistently have 99 to 100,000 of that used, your credit score is going to be significantly lower than if you paid that down every month or kept them paid down, kept your cards paid down. And so 2 things. One, if you have a lot of debt on your lines of credit, it not only does it hurt your credit score, it also hurts your debt to income ratio, because now your minimum payment on that is much higher, obviously, than if you kept those accounts paid down. So both of those can affect your credit. Make sure you're aware of that. And the second part of this kind of ties in. It's your not your utilization, but if you're getting new credit. And so one of the rules is you never want to go purchase a vehicle, purchase a car, if you're planning to purchase a real estate, and especially your own personal home, in the next 3, 6, maybe even 12 months. You want to be really careful about that, because if you go make a large purchase, especially something like a car, which you probably don't have to have, you go, oh man, I get this great car. Well, you're shopping for a home, and now suddenly you can't buy the home because you have this new debt, which messes up your ratios like we talked about previously, or it comes in and messes up your ratios, but also can affect your credit and so on. So inquiries when you're shopping also is the second part of this point. If you have a lot of inquiries on your credit, it lowers your score. And it also sends up a red flag that, hey, I'm shopping for credit. I may have new lines of credit or new purchases that will affect my debt to income ratios showing up on my credit. So just a couple things to be aware of. Keep those in mind. If you'd like to talk more, always click the calendar link below. I'd love to chat with you, take a few minutes and share with you some insights and help you plan for your next purchase. Lyndon Holdeman, Holdeman Realty Group. Let's talk soon.